My name is Jani. I'm co-CEO of Argentex Group PLC. We were founded along with my other co-founders, Harry Adams and Harry Adams, co-CEO, and Andrew Egan, managing director. Friends and co-workers who previously worked together at another foreign exchange brokerage. We left that firm in 2011 and formed Argentex, which started trading in 2012, backed by Pacific Investments, which is the family office of Sir John Beckwith. We listed in June 2019 and currently have a market capitalization of around 150 million. So in terms of what we do, we are an FX broker, a commercial deliverable foreign exchange broker. That means we cater for commercial transactions only. Our client base are essentially corporates, companies, financial institutions that have a need to exchange one currency for another. Only about 2% of our revenue comes from private individuals. We don't facilitate speculation, so we don't allow our clients to speculate. We do trade spot, forward, and FX options contracts for our clients. We don't take any house positions. We don't allow our clients to speculate, so we don't speculate ourselves. We operate as a riskless principal broker, which means that every time a client does a deal with us, we do a matching deal with one of our institutional counterparties, and that means that our revenue is derived only from the spread that we achieve. Over on the right-hand side here, just a quick reminder of our revenue progression to date since more or less inception, showing that really the core reason that we concentrate on the corporate market is that by far and away the biggest contributor to our revenue is repeat business. So in terms of how we work, well, what we don't do is operate what's called a 360 model, and that is one where the salesperson who initiates contact with a prospect and signs them up would then go on to manage the relationship going forward. We split our front office into two very distinct jobs, one being the sales team and one being the dealing team. We think they're two very different skill sets, require two very different types of people. The sales team, their only job is to bring on new business. That's all they're there to do. We recruit them from grassroots, and we like to do that because we like to train them to sell our way. They receive a commission of between 10 and 17.5% of the gross revenue that clients that they produced, brought to the business, have produced for the firm. Importantly, they are paid that commission for the life of the client. So if they sign a client up in year 1 and they're still with us in year 5, and that client trades is still trading, they're still earning a commission trail for them. If you look over on the right-hand side here, you'll see that this is the average amount of discrete revenue per year produced by our current sales team, depending on how many years they've been with us. The reason for this is important is that you can see they're very quickly earning quite a significant annuity stream that becomes quite hard to walk away from. In effect, they're creating their own LTIP. Once a salesperson signs up an account, they're passed on to a member of the dealing team. Each dealer, we think, can manage between 200 and 300 active corporate clients. Each dealer has a minimum of 10 years experience in the market. They're all regulated to give relevant advice where necessary, and they receive a flat commission of 10% of the gross revenue that they produce. In terms of addressable market, I've attacked this by way of who are we winning our clients from. The vast majority of our clients come from high street banks. A recent survey has shown that about 85% of UK corporates only use their high street bank or relationship bank for FX, and our experience would mirror that, with most of our clients having only used the bank previously. Sometimes we do come across clients who have other brokers in the mix. Generally speaking, when we come across the likes of a smaller retail broker, the types that you probably have heard of, that you'll see advertising at the airport, or a private client broker who's more specialized in helping people buy holiday homes abroad, that would usually be an indicator that the client is probably on the little bit too on the small side. Over on the very left-hand side of this graphic here, we're entering into the realm of micropayments platforms and challenger banks. So these are your Revoluts, your Monzos, your TransferWise. This is an area that is absolutely no interest to us whatsoever. We don't compete there, and then they're never going to be able to compete in what we do. On the right, we occasionally encroach on the bigger bulge bracket banks, people like Goldman Sachs, Deutsche Bank, but really, quite frankly, when a client is coming from this area, it generally is an indicator that they're really very large and very well looked after. So our target market tends to be clients that are trading a few million sterling in that region, up to a few hundred million. Once they get above a few hundred million, they really are being looked after very well by their incumbent prime brokerage or syndicate banks, being offered ancillary services like credit. And when you get below a few million sterling in turnover, there's really not very much we can bring to the table in terms of savings of well, cash or efficiency. In terms of who our clients actually are, this is a breakdown of our revenue and where it came from as per last year end, which was 31st of March. You'll see by far and away the largest section is financial services. That's pretty much anything that appears on the financial services register. Worth noting here that the second largest segment is other, and that itself comprises of 26 different sectors. Having a diverse client base is important because it means it improves the way that we can manage risk, and it means that we can make money with every market move. For example, UK exporters are more likely to trade when the pound is strengthening, and vice versa for importers. And this really just a snapshot of our performance to date across some of the key metrics that we look at. We've been profitable since inception. Last financial year, the year end, which is again 31st of March, we had 1,212 corporates that traded 12.1 billion sterling with us, generating 28.9 million in gross revenues. That period end represented a period of growth of 39% in gross revenue on a 3-year CAGR basis. In terms of interims, we gave you the interim figures in a trading update last month, but here they are again, just for reference. We'll get into the nitty-gritty in a bit, but looking past these bold yellow numbers, we're extremely encouraged by actually what has shaped them. And again, later we'll break down the raw data that demonstrates what we've experienced as a temporary slowdown in client trading activity over the summer months, thanks to COVID. And pleasingly, we have seen signs of return to normal levels of activity in September, when revenue was actually 57% higher than it was in August. There's a fairly interesting dynamic going on in this slight client slowdown. Both the average spot and forward trade sizes were up. Average spreads remained stable. In fact, they were around about a basis point higher. We had record number of new clients trading with us over the period, and 1,200 new clients trading with us for the first time over the relevant period. So over this unique period, the resilience of our business model and immaterial bad debt, coupled with the green shoots of activity and continued growth in both customer acquisition and staff numbers, reaffirms our short to medium term outlook. So looking in a bit more detail into the income statement, it's important to note that this really has been a period of consolidation of our growth ambitions. We've moved into new premises over lockdown, signing a lease on a new office to enable our expansion in headcount. We've been communicating to the market since we listed in June 2019 that our operating ratio would likely compress. We've seen it before in our first significant office move in 2015, and you can see it again here with our operating ratios currently running at around 31.6, and that's down from peak operational leverage around about 46% at year end. This has always been expected, and again, it's always been communicated to the market that we do expect this, and we expect this to return back to the mid-30s in the medium term as the revenue producing potential of our new hires reaches levels that we know it will do, and then further afield in the years to come, reaching back up into the 40s. Other than that, and the rest of the numbers remain largely the same. We've had a drop in some of the variable costs thanks to the lockdown, but obviously the increased fixed costs due to the new premises as well has had an impact. Moving on to the balance sheet, essentially the same business that floated. The only major difference from year end being the tangible assets that we now have to take onto our balance sheet thanks to IFRS 16. So we've got a 10-year lease here appearing on our balance sheet, and a largely equal and opposite liability. So broadly speaking, our total equity positions remain broadly unchanged. Looking at cash very quickly, it's quite difficult in a business like ours, primarily because when you look at the cash line in our statutory accounts, it actually includes client cash. So that is cash that client has sent us in either for collateral or that we're holding on to awaiting outward payment. So in the top box, if you strip these out, you'll see our net cash position here as of the period end. Notice that we're down slightly from the year end, and that's really as a result of two things. One, the increased capital expenditure for the new premises, and two, the dividend payment that we went ahead and made for the period prior. The second thing we like to look at is actually the cash generation of the business. Because we trade forward contracts, we recognise the revenue on trade date, but we don't actually realise that as cash until the client pays us. So it's important to keep an eye on when our revenues are actually turning into cash on our bottom line, and this would show that we have a very cash generative model. As of the period end, 81% of a rolling 12-month period's worth of revenue has become cash or will become cash within 3 months of the period end. Quickly looking into the interim statement now and the period, these graphs that I'm going to whiz through fairly quickly really set the context for the bedrock of what's underpinning our confidence in return to normal trading levels, and that is evidenced by the very end of the period, as we'll show in a minute, and also the trading activity that we've seen since the period end in October and currently in November. So we've had a dip in total revenue by quarter, not surprising given the given code and what's driven that. And you can see here quite a drastic decrease in the FX volume traded by quarter. Now, what has driven that? Obviously, earlier we looked at the slide which said that average trade sizes were up and the number of clients was up. What was down was this total number of trades. If you look over here on the right, we've drawn out. It's worth noting that our financial year end is 31st of March, but all of these graphs are calendar year, so I've drawn out the relevant period in blue. We draw this out further into more granular detail on a monthly basis. You'll notice a significant jump from August to September. Really, again, this is the start of those green shoots of recovery that I mentioned earlier. So the number of spot deals over the relevant period fell from 7,000 to 6,000. Number of forward deals fell from 1,500 to around 1,400, and compounding that, the average tenor, which is the number of days forward that the client books, fell to around about 110 days, and I'll come on to why that's important in a second. Looking at the revenue in more detail, really, just looking to show September 2020 revenue was 57% higher than August just gone. Now, if we saw more clients, more new clients, bigger forward deals, bigger spot deals, and just fewer of them, what does this actually suggest to us? We've termed this temporary decision paralysis, and that's what we're looking at here. The graph on the left is showing the average number of days between a client first signing up with us and then executing their first trade with us. And on the right-hand side, this graph is showing the number of new corporate trades by quarter. You'll notice a very significant jump on the very right-hand side of both of these metrics. Turning over the slide, this is essentially the last two charts superimposed onto each other. Temporary decision paralysis leads to a decrease in days to first trade, because although that seems a bit counterintuitive, clients that have signed up with us but are waiting to trade won't appear in the data until the quarter that they actually trade. And you'll see, if you look at the dynamic between the two, there's a clear interplay between them, but on an almost lagged basis. For example, look back at what happened before in 2016 in the referendum, the EU referendum. So as temporary decision paralysis unwinds, the days taken to trade jump, in this case very dramatically, as you see at the end of the period. And this is how pent-up deals that people have been waiting to trade manifest as observable data. It's also what we're experiencing in October and November, which this previous short-term decision paralysis that was leading to depressed levels of trading, followed by increased new client activity. Client activity as a whole increasing, leading to increased FX turnover and ultimately revenues. If you look back historically, you'll see this happening before, so it's nothing new for us. You'll see it happening at least 4 or 5 times to varying degrees over this period. Importantly, we've been here before. We know what happens, but most importantly, we know what happens immediately afterwards. And obviously, there's no guarantees, but this is a very strong indicator to us, and we're seeing very early signs from September onwards that would support an unwinding of this decision paralysis. I mentioned forward contracts earlier. One strong indicator of client certainty amongst our base is their behavior when it comes to the number of forward trades. and that's what's shown on this graph here. The more certain our clients are, the more forward deals they put on with us. And you can see how this uncertainty manifested itself in this quite severe drop over the period. August was pretty rubbish, as it normally is, but if you look here, you can see we returned to a bit more normal levels of activity in September, and similar trajectories continued post-period end. As well as a number of forward trades, actually a better indicator of certainty is the average tenor, and that's how far forward a client's book with us. Clients don't want to book any further forward than they have absolute certainty for, and that's really the crux of the why clients are booking less with us over the period. On a monthly basis, you can see a return back to far more normal levels towards September here. Looking back to April, 79 days, that was the average forward deal that was placed with us. You have to go back to the beginning of April 2014 in our data to see anything anywhere near as low as that. So that really is extreme compression. Now, we can't point to any single one of these metrics and use it as an indicator or predictor of near-term outcomes, but when you take them all together, and please do that if you do download the presentation and look at all of the graphs in conjunction, hopefully you can see holistically why in the medium and longer term we're very confident that the unwinding that we're seeing is going to translate into higher volumes and ultimately revenues. Just operationally speaking, quickly speaking, we signed a new lease on a new London HQ during lockdown. We were lucky that the fit out then also occurred during lockdown, which meant there was no retrofitting required. We have a capacity for 140 staff. We currently have about 70, 23 new hires from April over the lockdown period, which meant that our sales team has increased in size by 62%. Overseas expansion is continuing at a very pleasing pace. We already have an office in the Netherlands, which again was set up during the lockdown period. We signed up 52 clients to date, with 12 alone being signed up in September. It's already revenue producing, and it's clearly our Brexit contingency plan as well. Looking further afield, both in terms of geography and also time, we have identified a local CEO to run our Australian business. We've registered Argentex, PTY, and PwC are making good progress with our regulatory applications. So in summary, the trading environment during this unprecedented 6-month period has led to a downturn year on year. If you take snapshots, however, any historical quarters for a trading business like ours, it's nothing new. As I mentioned before, we've been here before, and importantly, we know what's coming afterwards. The fundamentals of our business remain strong. In fact, I'd go as far as saying they've never been stronger. We've experienced a record number of new clients trading in the second quarter, sourced by our ever-expanding and increasingly capable sales team, which bodes extremely well for the future. In terms of outlook, there's no getting away from it. Uncertainty remains. Today, I'm presenting to you from a lockdown, which we didn't even foresee just a few weeks ago. Despite there being light at the end of the tunnel, we must remain cautious. We have, however, demonstrated that what has happened historically in times of client uncertainty and hesitancy, and given the trading activity and volumes we've seen over the last 3 months, we've got very high levels of confidence that trading and therefore our growth are going to reach very high levels in the short term. We're very pleased with the way Argentex have navigated the last 9 months. Essentially, we think we've passed the stress test with flying colours, and we look forward to the return of meeting short-term expectations, delivering to stakeholders what we set out to do at the IPO. Thank you very much. That ends the presentation. I'll be very happy to take any questions.
Okay, how do you define a current/active client? How recently does a client have to be traded to remain considered as active?
A client is active in a period if they've traded within that period. So when I mentioned, for example, 1,212 active clients in the last financial year, that meant they traded within that period. A client isn't necessarily inactive if they don't trade within that period, because we have the ability to trade as far forward as, for example, 5 years. So we do have the occasional client, for example, a retailer who might book out 4 or 5 years worth of their expected dollar exposure. Once they get rid of that risk off their table, they're unlikely to appear in the next few years' data. So although they may not trade with us, they're not going to be, their data isn't going to show within the period. That doesn't mean that they're not an active client, though.
Did you have to furlough any staff, and if so, what impact did this have?
No, we didn't furlough anybody.
Are there any regulatory issues with Brexit?
Yeah, there are huge regulatory issues with Brexit. MiFID, I could probably keep going for another hour and a half on this, but I'll try and keep it a little shorter than that. MiFID II is designed to be a harmonisation directive, but obviously we're coming outside of that. The UK's implementation of that is likely to be largely aligned with that of the EU's, because we're going to want to carry on doing business with the EU. So in terms of regulatory issues, yes, if we want to keep doing business with European clients, we're going to have to adhere to European rules. We still don't know what sort of shape a deal will take, if there even will be a deal. For example, we're currently relying on what's called passporting, which means that any European member state considers the FCA, the UK regulator, as an equivalent regulator to their own. So they assume that no further oversight is necessary. Post a deal or no deal, depends what shape the deal will take. But that's why we've looked in the Netherlands to expand into as a contingency plan for that.
On the slide where you showed your target market, you mentioned that the bulge bracket firms offering ancillary services, things like credit. Are there any ancillary services that you offer your clients?
No, everything we do is around FX and hedging and removal of FX risk. How they do that, they might do it in a spot contract, a forward contract, an options contract. We do have an online platform, but no, everything is FX. We stick to what we have.
And do you see any kind of pressures on margins? You mentioned it's all your revenues on that spread, and is that kind of changing at all? Is it widening, narrowing, or any pressures to that?
No, we view spread very much as an output rather than a target or a KPI. We don't like to aim for a certain spread. So looking at the spread evolution over the last well, since inception, no, there's been no price pressures whatsoever over the period. It's actually gone up.
And you mentioned about staff, and you showed the revenue per salesperson over that 5-year period. And you mentioned at the start that you and your colleagues left somewhere else to start the firm. What the barriers to entry, I guess, is the question. How difficult is it, or is it difficult for a bunch of your guys to go and do it elsewhere, or anyone else from any other firm for that matter?
Yeah, sure. You kind of answered the question yourself in your question there, and that is the barriers for entry is a massive hurdle for people to leave and set up on their own. When we started Argentex, we actually could have done so from our own bedroom because the regulatory environment was very, very different to that it is now. The amount of regulatory capital required was almost nothing. There weren't even things like, well, the FSA, as it was then, didn't even consider FX a regulated product. So I may as well have been selling used cars. That's obviously changed somewhat since. And so the regulatory environment is very much more tough, as I believe it should be. Also, in terms of the individuals looking to leave, if they're a significant key player in the firm, they are likely locked in not only from their own revenue streams. Our highest earners are earning well in excess of £1 million sterling, but on top of that, they'll be incentivized to a long-term equity-based long-term incentive plan. It's extremely unlikely that anybody would leave. We've never lost a key member of staff.
And on that, I've had a question about the composition of the register, the percentage ownership of management, and any other kind of key institutions that came in on the flows.
Sure. So insiders own approximately 60%. So that would represent management, which hold just over 30% in total of the firm. And key institutions at float would be the likes of BlackRock, AXA, Gresham House, that sort of thing. We've got a very good free float, which is largely institutional based.
I'm going to read this one out in its entirety, so I'll make sure I get the question right. The questionnaire said, I'm the owner of a number of retail stores and saw a circa 50% reduction in revenues during the pandemic. I'm expecting revenues to bounce back to 100% of the time, but I'd be lucky if they bounced back up to 150% and made up the shortfall. How confident are you that the paralysis / pent-up demand still exists? And if it does, how much of a bounce back would you expect to see, and over what time period?
Good few questions in there. There's no getting away from it. And coupled with the decision paralysis, there's undoubtedly an economic contraction that's happened as well. It's probably going to continue slightly as we go back to more normal levels of GDP over the next year. And there's no getting away from the fact that any downturn in overall economic activity is going to be negative to our clients. their latest figures shown today show about an 11% reduction in GDP overall. I think in answer to the question, that goes back to having a broad, diverse client base in terms of how much of it is pent up and how much of it is lost to economic contraction. The honest answer is I couldn't put a figure on it. However, the rate of new client acquisition we feel should more than outweigh any economic contraction.
Again, I'll read this one out to make sure I get the correct sentiment of the question. How does your customer pricing policy work, i.e. that short-termism by a dealer doesn't damage the client relationship?
Sure. I think relationship is the key word there, and we are looking for a long-term working relationship with a client. That's really the only way that our business model is viable. The pricing really is secondary. For any client that price is a primary driver of their choice of who they use for FX, we're unlikely to be their key provider. Our clients are essentially people who like speaking to people and want an informed, regulated advisory service, and that's what we give. Our clients know that we charge a price, but it's very transparent, and they can see what we're charging, and everyone's happy.
And finally, dividend policy. Could you talk through the dividend policy as it's kind of set out?
Yeah, sure. As of floating in June 2019, our dividend policy was to pay out 30% of retained earnings on a cash adjusted basis. We have taken the decision to not stop that, but to review it. We don't think it'd be prudent in the current environment to declare an interim dividend. We didn't pay an interim dividend last year, and we'll be communicating to the market our intentions at year end.